Hi all, welcome to i-tutor Academy. In today's session, we will start with Unit 5 of MMPC 010, that is demand elasticity. So, objectives of this unit are understand the concept of elasticity, define various kinds of elasticities, apply the various measures of elasticity to real world situations, and structures are introduction, the price elasticity of demand, arc price elasticity, point price elasticity, and the revenue determinants of price elasticity, income elasticity of demand, cross price elasticity, and the effect of advertising on demand summary, keyword section, and self assessment questions are the structure of this unit. So let's begin with the introduction part. In this the previous unit we studied that when price falls, quantity demanded would increase. While we know this qualitative effect exists for most goods and services, and managers and business analysts are often more interested in knowing the magnitude of the response to the price change by how much, and there are many situations in which one might want to measure how sensitive the quantity demand is to changes in a product's price. And economists and other business analysts are frequently concerned with the responsiveness of one variable to changes in some other variable. It is useful to know, for example, what effect a given percentage change in price would have on sale. The most widely adopted measures of responsiveness is elasticity. And elasticity is a general concept that economists, business people, and government officials rely on for such measurement. For example, the finance minister might be interested in knowing whether decreasing tax rates would increase tax revenue, and likewise, it is often useful to measure the sensitivity of changes in demand to changes in one of the determinants of demand, such as income or advertising. And elasticity is defined as the ratio of the percentage change in quantity demanded to the percentage change in some factors, such as price or income, that stimulate the change in quantity. The reason for using percentage change is that it obviates the need to know the units in which quantity and price are measured. Okay. Example, quantity could be in kilogram, gram, liters, or gallons, and price could be in dollars, rupees, euro, etc. And a measure of elasticity based on units would lead to confusion and misleading comparisons across different products. The use of percentage change makes the measure of elasticity independent of units of measurement and hence easy to understand. And elasticity is the percentage change in some dependent variable given a 1% change in an independent variable, ceteris paribus. And if we let y represent the dependent variable, x the independent variable, and e the elasticity, then the elasticity is represent e is equal to percentage change in y divided by percentage change in x. That is the equation. So here is the equation of arc elasticity. Two forms of elasticity is there. One is arc elasticity and a point elasticity. So this is the equation for arc elasticity. Okay. And the form works here. The point elasticity indicate the responsiveness of the dependent variable to the independent variable at one particular point on the demand curve. So this is the point elasticity's equation. Okay. And please go through it, your ignore study material, so you will get these equations. Okay, so economists use a great variety of elasticities. The following three deserve particular attention because of their wide application in the business. Okay, so price elasticity, income elasticity, and cross price elasticity, and this we will discuss. And first one is the price elasticity of demand. What is the elasticity? Price elasticity of demand measures the responsiveness of the quantity sold to change in the product price, and ceteris paribus, and it is the percentage change in the sales divided by a percentage change in price. The notation EP will be used for the arc price elasticity of demand, and EP will be used for the point price elasticity of demand. And if the absolute value of EP is greater than 1, a given percentage decrease in price will result in an even greater percentage increase in sales, and in such a case the demand for the product is considered elastic, that is the sale are relatively responsive to price change, and therefore the percentage change in quantity demand will be greater than the percentage change in the price. And when the absolute value of the price elasticity of demand is less than 1 and the percentage change in sales is less than a given percentage change in price, demand is then said to be the inelastic with respective to price. And unitary price elasticity results when a given percentage change in price result in an equal percentage change in sales, and the absolute value of the coefficient of price elasticity is equal to 1 in such cases. Okay, so these are the relationship are summarized here, and please go through it. And next is arc price elasticity. Consider the hypothetical price of some product and the corresponding quantity demand as given table is here 5.1. So this is the demand schedule to demonstrate the price elasticity. Okay, so that is a table you just refer from your IGNOU study material. And arc price elasticity between the two lowest price between 30 and 10 as follows. So this is the equation for that. Thus the demand is inelastic in this range. This value of ep is equal to minus 2.5 means that the 1% change in price result in a 0.25% change in the quantity demand in the opposite direction of the price change over this region of the demand function. So that is an example for the uh, arc price elasticity. Okay, so next one is point price elasticity. What is point price elasticity? The algebra equation for the demand schedule given in table 5.1. Okay, so this is 5.1. Based on this the demand schedule to demonstrate price elasticity. So based on that, here is p is equal to 100 minus 0.25 q. Okay, q is equal to 400 minus 4p. So based on equation we can explain the point price elasticity. Okay, so we can use this demand function illustrate determination of the point price is this. Let's the equation we refer in the 5.2. Okay, please refer that section also. And this example shows that the price elasticity of demand may and usually does vary along any demand function and depending on the portion of the function for which the elasticity is calculated. It follows that we usually cannot make such a statement as the demand for product X is elastic because it is likely to be elastic for one range of price and inelastic for another. Usually at a high price demand is elastic while at a lower price demand tended to be inelastic. Intuitively this is so because lowering price from a very high level is likely to stimulate demand much more compared to lowering price when price is already low. An illustration, consider the price of cellular phone when these were first introduced in the Indian market at price range between 25,000 to 30,000 per handset. And demand was limited to the higher end of the market. As this price fell, demand as stimulated and resulted in increasing penetration in the middle and lower end segment, indicating an elastic response. Okay, so activity 1 is based on here. Please try to do it, and this is all about today's section. Next session we will discuss on next video, and for more MBA series you just do like, share and subscribe our channel. Thank you so much.
i-tutor Academy presents IGNOU MBA Complete Syllabus Coverage Classes for individual students, semester-wise subject with online flexible timing. For more details, contact on +91 623 827 1885